business in Africa. You can't afford to be without Africa Investor.
So I'm just going to start by welcoming you on behalf of Africa Investor, the Continental Business Network and the African Green Infrastructure Investment Bank to this institutional investor consultation on the International High-Level Panel on Water Investments for their Africa report. As many of you may know, I serve on the advisory board to the International High-Level Panel on Water Investments for Africa, which is essentially a heads of state-led private capital mobilization initiative to address the water security issues across the African continent. A specific objective of the high-level panel is to establish African water as an internationally competitive investable asset class and recommend pathways to assist panel members champion the mobilization of $30 billion of private capital annually between now and 2030. But I think we can already begin to closer align with some of the other SDGs, the Paris Agreement, and Africa's own Agenda 2063, which is for the year 2063, and with the focus of addressing Africa's water investment deficit. So the reason we're here is that a high-level panel report is being prepared to feed into the UN 2030 Water Conference and other sort of high-level investment-related events relating to water this year. The report will be the continent's roadmap to close the water investment gap and showcase institutional investor recommendations about how to mobilize private capital at scale for African water investments through institutional investor public partnerships. This invitation-only water investment leaders consultation, co-hosted by Africa Investor, the Continental Business Network, and the African Green Infrastructure Investment Bank, will be instrumental in assisting the consultant, Guy Hudson, who's with us now, include practical investor recommendations, facts, and key messages within the high-level panel's report, with the goal of really stimulating institutional investor interest in African water as an investable asset class, and of course to deepen the understanding of African government leaders and garner their support, their ongoing and consistent support around the implementation of catalytic private capital mobilization opportunities and reforms. Guy has kindly shared with us the draft of the report yesterday, and on a sort of a for our eyes only basis, so please do not circulate it. And along with that, he also included a presentation. For those of you who haven't received that, we'll circulate it after the meeting, but I think Guy will be taking us through the majority of that data. So today's agenda includes sort of this welcome opening remarks from myself. I'll be chairing the meeting. It will then be followed up by a presentation to investors on the high-level panel's report, and that will be done by Guy. That will be then followed by a number of interventions, what I've described as successive investor recommendations and reflections to the high-level panel and Guy to note, hopefully, and then it will sort of close out with a Q&A discussion around both sets of those conversations, and then we'll have a sort of a 2-minute closing remarks. As I mentioned, Guy has included in his presentation, for those who haven't received it, it's the last or penultimate slide in his PowerPoint presentation that hopefully you would have received yesterday for those who received it. His key sort of questions for us to ponder as we think and listen to all presentations today and think about our interventions are: one, Africa is made up of 54 heterogeneous countries. How do we as investors see this being sort of conglomerated or decoupled, or do we look at sub-regional, do we look at continental, just national? He's asking us some of those particular questions, and that's one of the key things that he would like us to be able to answer. His next major issue that I think he'd like us to be able to talk to as well is, what are our perceptions of the 3 major bottlenecks, and he will talk about those specific bottlenecks to investing in water security in Africa, and just sort of whether they're surmountable, if so, how, if not, why. And then his last sort of major big ask and question is what else is needed in the report, which he's going to take us through from the perspective of both domestic as well as global institutional investors, and what additional reference materials or facts should he know about. So with that said, we come to the end of this welcome opening few comments from myself, and I now call on Guy Hutton, the consultant drafting the report, to give us his presentation on the high-level panel on Water Investments draft report. So over to you, Guy.
Thank you very much for the introduction, Hubert, and thank you for the invitation and opportunity to meet with you all. This is a really vital sort of group of stakeholders, and your viewpoint and your perspectives needs to be reflected in this report. Just a couple of words about myself, which may explain some of the biases you may see in the report. I am an economist. I came from academia, then I worked for 10 years with the World Bank, and for the last 6 years I have been with UNICEF in New York, leading their the water economics and financing work, and recently became independent, so I had the opportunity to be drafted into to lead the writing of this report, which I have to say is one of the most interesting things I've done in my career, but challenging, because we've already been through a couple of iterations. It'll take maybe a couple more to get it right. Okay, so we have already held some consultations at the inception phase, and we're holding several more meetings this week and next week. Yeah, this is quite broadly consulted in the time we have. Just to remind you, I don't know how many of you have managed to open the report, but the primary audience is heads of state and top levels of African governments. This is what we're aiming at, so the messages have to be at that level, but I think this audience needs to be aware of what they need to implement through their various arms, their ministries, their committees, and so on. So the report does go into quite a lot of detail about what needs to be done. And it's also been advised that the report should speak directly to heads of international finance institutions. So there are various targets that are also framed for them. This is an outline of the report. Chapter 2 spends a bit of time going through some of the weaknesses that are perceived or actual for investment in water security in Africa. And some of the broader enabling environments challenges are really key. I mean, those are some of the first hurdles that you come across before you even get to the water sector. So that's why we spend some time on it. And then in terms of the water sector itself, there are many challenges. Sometimes we talk about challenges more than opportunities. So we've got to be honest, say what the data are telling us, but also say actually a lot of these challenges are investment opportunities. And if we can get some things right, then we can attract more resources to the sector. And then chapter 3 is the main part of the report, goes through actionable pathways, and I'll be giving more detail in this presentation today on those. So after quite some consultation, we've sort of come on these major sources of additional funding and finance. And we do split the terminology, isn't used by everyone, but funding is more public funds and financing is more repayable finance. And that's the terminology this report adopts. So in terms of the funding, a lot could be saved. A lot of the financial gap could be reduced by lowering service unit costs. And we aren't saying that we're going for the cheapest option, but we're trying to achieve efficiencies in the sector because at both the sector level and at the operator level, there are a lot of inefficiencies which can be improved upon. The second is tariffs for water services. This not only raises money, but it also makes the sector more investable by investors, by private sector clients. And so this is a really important one. And many big players have been banging this drum for a very long time. So it is not an easy one to crack because it's so politically charged. But there's a lot of rationale for increasing tariffs while ensuring that those who can't pay have a mechanism to receive the service. And then the climate and other international funds are vital. The water sector has managed to obtain very few of these so far, but we are talking in the tens or hundreds of billions globally, which the African water sector should surely be able to claim for some of the adaptation funds. Then there are new donors. This is a bit of an unknown bag. China and India already invest quite a lot in Africa, but there's probably some opportunity for further investment from new development banks and from the bilateral programs of BRICS and other new donor countries. And then fifth is public finance. While we may not expect massive amounts, because just to get a 5 or 10% increase in the budget for the water sector is already a big challenge, and that doesn't bring billions to the sector, but it is vital to help support sector growth and to leverage and crowd in private finance. And then other types of finance that are being mentioned by some stakeholders, and which could raise considerable money, compliance fines for production and agricultural facilities who are polluting water, to try to internalize those costs that are causing costs to others downstream. We haven't made any calculations, but Ceres, the NGO, has actually made some estimation for some meat packaging and the other one is appareil sector. So a lot could come from there. And then mineral resource tax has been talked about and could provide additional funding if it can be earmarked for the water sector. And then major sources of additional repayable finance are international investors, national and commercial banks. But for these, we need bankability, we need creditworthiness. And for this, we may need to use the blended finance mechanism to crowd in private finance. So the pathways to mobilizing $30 billion per year for Africa is the following. Pathway 1 is to strengthen the enabling environment and to achieve more impactful spending. Quite a lot of the funds being allocated to water are simply not being dispersed. So we have 50–70% disbursement rates. So there's resources that are allocated that can't even be spent due to capacity and problems in the public financial management system. Then pathway 2 is domestic resource mobilization. I've been through some of those sources in the previous slide. And pathway 3 is to mobilize global and continental finance. And we don't have estimations yet of how much could be raised from each source. It's rather hard to make those calculations at the Africa level, but we will sort of draw on whatever numbers we can to say what the potential is. And to achieve all these pathways, we need to have political support. We need top levels of government to put their weight behind it and to sort of help mobilize, especially the private finance. So just for information, steps within each pathway, we try to sort of get down to a level of detail that allows governments to know what is really being asked of them, is mapping and understanding the potential for each pathway, strategizing and planning how to close the gap through the pathway, building capacity and preparing for implementation, then implementation and monitoring and evaluation. So this type of pathway step is quite common in sort of development sector, but if you see any gaps or any ways to improve it, we are interested to know. So pathway one, I'm not going to go through all this because it's too much detail, but there's a whole host of ways to improve the efficiency of spending, but both public funds and private finance. This is not even a full list, and is well known, and many of these are being implemented by countries. Some of the actions to strengthen water providers are listed here. I won't go into these, as I think it's beyond the scope of this discussion, but certainly you'll be interested to know how water providers can become investable, and we can sort of formulate investment vehicles so that more water businesses can receive private finance. Then domestic public resource mobilization are all these. In red are the ones that have greater potential, and I've already spoken to some of these. And then there are three sub-pathways. One is to increase overall finance, so attracting money to Africa, which wasn't previously allocated to Africa. The other is to obtain a greater share of finance for water security. So that's sort of taking from other development sectors in Africa, so that water gets its fair share. And then the third is increased efficiency of existing and new spending, which, as I said, can raise considerable sums or save considerable sums. And then in terms of the global and continental finance, I think the institutional investors is a major one that everyone is looking to, but no one really knows how to achieve that. We talk about hundreds of billions of pension funds, of African pension funds, some of which gets allocated to outside Africa. How can that be attracted to stay in Africa? And I won't go through each of these, but I'm sort of put a call out for other funds that haven't been listed here so that we can be more complete. So just a few words about how to prepare the ground and implement on this pathway. One is to develop a project pipeline with strong rationale for international and investor funds. Another is to increase familiarity of international investors with the water sector, because they may have perceptions that it's, it doesn't provide the returns they need, or it's too risky. And so we need to understand the needs and the perceptions to sort of change them. Then we need to implement supportive legal and regulatory measures, and I know that Hubert and the Continental Business Network has really worked on this and has some very good recommendations which are taken into the report. Then to implement measures to increase operator financial viability and improve creditworthiness, as I mentioned earlier. To develop and implement financial instruments that are fine-tuned to the development context. So what are these financial instruments? It's a great word, but what do they look like, and how are they going to incentivize investors to come into this space? And then close the deal. There's a lot of money out there, there's a lot of demand for money, but there's limited forums in which to bring them together and sort of close the deal, as it were. We talk about blended finance a lot. It's sort of similar to public-private partnerships. It's essentially leveraging private sector money using public funds. And this framework, this graphic sort of brings some clarity as to where the different types of blended finance that can be achieved at different levels of project size and different risk levels. So we'll be using this graphic in the report. And this is the final slide. So we've made a number of targets. There are probably too many at the moment, but I've extracted some that are more relevant for investors, which we should try to get agencies and international finance organizations to commit to. I think that in the report we won't be able to sort of get the commitment, but we'll use the report at the UN Water Conference and other meetings to try to get buy-in to setting targets and getting buy-in from the key players. So I don't think we have time to go through each of these, but this is an indicative look at what the targets might look like. And then there's a very short chapter on next steps, so that we sort of have an immediate pathway for implementing these recommendations. Yeah, these are still in formulation, but essentially some of the key steps that are needed, including generating evidence and having the studies and project pipeline that is needed, as well as the champions to, both within and outside the water sector to bring finance to it, and then start implementing proposals for sector strengthening. So there's a lot of already good initiatives going on, which just need more players to get behind, and we need a cohesive roadmap which everyone buys into, rather than everyone doing their own thing. And the water sector has been said to become increasingly fragmented, and we need to sort of address that up front in this report. So I hope that wasn't too quick, but it provides you a snapshot of what the draft report is saying. As I said, that it will be going through several more consultations in the next 2 weeks. Yeah, I think time to hand back to the chair, Hubert, to take us through the discussion. Thank you.
Wonderful. Thank you very much, Guy, and congratulations on what has clearly been a very comprehensive background research, consultative process, and we're really keen to be able to contribute positively to that. I'm mindful that we are, one, short on time, and two, we haven't given reflections or just sort of introduced ourselves. But in the interest of time, let me just welcome Matthew. These are the people that are on this particular call right now, so each of you can get a sense of who else is there if you haven't met before. So we have Matthew DeSirio, who is the president of Water Asset Management in the US, a very prominent and prolific investor across the both public and private sector as it relates to water. We have Dr. Sharon Fitzgerald, who is a partner at DLA Piper and one of the key architects of the Institutional Investor Public Partnership Model Law. We have Kate Hughes, who is the CEO of the Resilient Water Accelerator at WaterAid. We have Eloy Lindigier, who is an advisor to Australian Super and former PGGM CEO from the Netherlands. So it's good that we have the Prime Minister of the Netherlands as one of the key players on this particular panel. And the high-level panel itself. We have Joseph Boating, who is the Chief Investment Officer of Casey Family Programs, calling in from the United States. We have Ngatia Kirungi, who is the CEO of the Kenya Pension Fund Investment Consortium, a consortium of 28 pension funds in Kenya, investing along the principles of the 5% agenda from the African Union and across all sorts of different asset classes. We have Demba Diallo, who is the CEO of FONSIS, which is Senegal's sovereign wealth fund. He's calling in from Dakar. You're welcome, Demba. And again, we applaud His Excellency President Macky Sall's leadership, really driving this particular panel. Solomon Asamoah, who is the CEO of the Ghana Infrastructure Investment Fund, will be calling in later from Accra. As we talk about pension funds, we have Anne-Marie Dalton, who is the CEO of BATSETA, which is the umbrella organization for all of the retirement industry and pension funds in South Africa. And many of you will know South African assets represent 70% of the entire continent's pension fund assets. So we're very pleased to have you with us, Anne-Marie. We also have Eric Krypton, who is a director at Caisse de Dépôt in Canada. Again, one of the world's largest infrastructure investors, pension fund infrastructure investors. So with that, I just wanted to give everyone a sense of who else is in the room. And we've now had Guy share with us information on the report. Now, Guy, we'd like you to sort of take some views that come from our constituency on the type of incentives and risk protections investors anticipate to consider African water as an investable asset class. So we have a few speakers, and I'll just go through them one by one. We'll start with Matt Well, Matt, please keep to 3 minutes. Everyone, please keep to 3 minutes, mindful of the fact that we're running out of time or slightly over time. We have Eloy Lindiger who will comment. We have Joseph Boateng who will comment. We have Ngatia that will comment. Demba Diallo will comment. And anyone else is welcome to do so. Thanks very much. Over to you, Sharon.
Hi everyone. I wanted to talk about the model law for institutional investor public partnerships, which we've been working on and launched the final version at COP27. And in terms of the three issues, Guy, that I would just very briefly touch on, and some of these are already in the report. From a legal and regulatory perspective, there is, of course, the need for any particular country to be ready for investment, and that readiness for investment in a legal regulatory context could be things associated with rule of law, fraud and corruption, dispute resolution, sanctions, ESG considerations, control of crime and corruption. So I'd say that's at the base level, and that actually cuts across all sectors, not just the water sector. But these will be the sorts of areas of law that investors will be looking at to see that the law is robust. Second level is then the regulations relating to the sector. So in the context of water, those sorts of regulations could relate to whether or not there is an independent regulator in the country, or if water regulation is carried out by the ministry. Essential questions such as, can the private sector be involved in the provision of water supply, wastewater, sewage treatment, etc.? How are tariffs and subsidies managed? Concession project I'm working on at the moment, the big risk on the project is how the tariff methodology operates in practice, how the regulator can change that over time, what is the risk to the project of those tariffs being changed. Then more generally, in terms of water, there would need to be regulations on water supply and quality, the treatment standards for wastewater and sewage, pollution control. You mentioned about fines, for example, for polluters, and finally regulations related to flood and drought prevention. So those are the first two levels that are relevant from a legal and regulatory perspective. And then the final level, and that's the level that the model law deals with, and that's a level that relates to procurement. And something that, and I did have opportunity to have a brief look, Guy, at the report this morning, and it struck me that there's a lot that has already been identified in terms of the enabling environment. But in terms of the procurement of projects, my concern would be that because we don't have much time before 2030, that we will get that we will work on the enabling environment. But what we need to do, I'd suggest in parallel, is to work on the procurement strategy and models for bankable water projects. And perhaps I'm speaking from the context of the audience in this call, but I do feel from my experience working for both government and private sector is that what is essential is to be having some upfront engagement with investors. And I'd actually go further than the normal preliminary market engagement that happens in projects. I would actually be suggesting that, given that we know that there is a funding and financing gap, that as a given, governments should be able to work with investors upfront to actually design projects which are of the scale and type required to allow institutional investment to take place. So that idea is novel in the context of most procurement systems, PPP laws, not just in Africa, but generally in other global locations. But that would be my my thought. So I'll shut up now and pass back to Hubert. But we've prepared some slides, Guy. We have the model law itself, and so we'd be very pleased to be sharing that with you to go through some more of the detail.
Thank you very much, Sharon. That was very useful, and I think Guy already understands the import of that legal and regulatory framework. We hear lots of people, totting up the big figures and the big numbers about the gap. But recognizing that the legal and regulatory architecture is the key to ensuring that capital can flow, I think sometimes gets overlooked. We use big, broad statements like enabling environment, and I think in the context of private capital, those issues I think will need to be a bit more forensically, unpacked and clarified to give capital the confidence to flow at scale in those. So as Sharon mentioned, we'd be very happy to continue to help, contribute ideas and best practice as far as that is concerned in the context of the institutional investor public partnership model law. I'm now going to move back to Matt. Hope I don't hear two Matts this time, just one, no reverberation, but let's hear you.
Okay, thanks. So Matt Desario, co-founder, Water Asset Management. All we've done for the last nearly two decades is invest globally in all different kinds of companies that ensure water quality and water supply. So everything from regulated water and wastewater utilities to all the different kinds of companies that make, the pipes and the pumps, the meters, the treatment, the technology. We're a very active water rights investor, both in Australia and in the United States. We look, like everybody on this call, we've seen how colossal water problems can be, but there's not a water problem on Earth that's not solvable. And what's required is capital, competence, and the will to act. And when we're big believers, we've been working with Hubert, consistently for the last few years around the importance of regulation. And by regulation, I'm going to be very specific because regulation can mean a lot of things. The regulation we're talking about that we believe is really the magic bullet, because we've invested successfully, by the way, for all these years in places, whether it's the US or the UK or Chile or Brazil or the Philippines or Italy, Australia. It's regulation. That is the magic bullet. We get asked all the time, oh, what's the technology or product that's going to, be the magic bullet to solve water? The magic bullet is the right regulation. And the kind of regulation that I'm talking about is the regulation that provides transparency, long duration certainty, and long duration opportunity and regulatory certainty to large scale capital, because that's what large scale capital requires in order to be committed. And the government funding, I would encourage this group to really focus the government funding on spending not to necessarily fund water infrastructure, but initially spend government funding and development funding to develop projects, develop assets, I should say, that are available, and then most importantly, develop the regulation. And the regulation I'm talking about, as I said, it exists already. It exists all over the world. And what we can do here is really kind of selectively kind of cherry pick the best aspects of that regulation from Ofwat, from our CESP, from the Public Utility Commissions in the United States, and consolidate them. There is no better business anywhere to invest in for long duration capital, i.e. pension type capital, than an investor owned water and wastewater utility that exists in a constructive, transparent, durable regulatory framework. There's no better business. Why? Because it's a monopoly. Typically, these monopolies are allowed and regulated through tariffs to earn roughly a 10% return on equity that is essentially indexed to inflation. I mean, people on this call, think about how hard it is to earn a real 10 for decades, let alone for 1 year. That's what the regulation does. That's what the regulation incentivizes. And it does so in a very transparent, that's the key, transparency and accountability. And that's what is, I mean, look, none of it's perfect, but it works. And and the key is to make sure that it's iterative. That's where regulation falls down when it's not dynamic and it's not iterative. One of the things we say is that the pipes, the pumps, by the way, the leaky pipes, you know, the broken pumps that need to be repaired, the unreliable needs to be improved water supply in California or in the UK or in Brazil. It's the same set of assets and the same set of circumstances as those assets in South Africa. The difference between why hundreds of billions of capital flows to some places and doesn't flow to places on the continent, it's not the assets. They're the same assets. The customers, they're the same people. What's the difference? The difference is the regulatory overlay, the regulatory framework. When the capital sees and is comfortable with that regulatory framework, it flows in that direction. And that regulatory framework, to be successful, as I mentioned, it has to it has to deal with some very, very critical issues. And there's techniques. For example, foundational is universal metering. Secondly is full cost pricing. In other words, the tariffs need to be set in a way that covers all the costs, the operating costs, the capital costs, the debt and equity costs, the cost of ensuring reliability. Typically, when we say that, then people respond, well, gee, what about people that can't afford it? Well, that's where you use tiered volumetric pricing. So for the first 100 gallons, it's a penny a gallon. The next 100 gallons, it's 2 pennies a gallon. If you're using 10,000 gallons, it's 10 cents a gallon. And again, I'm just kind of throwing those numbers around just to make the point where you can create these mechanisms, especially with smart metering, that enable that kind of pricing to also be dynamic. There's very interesting and innovative ownership structures that bring the ratepayers into actually the ownership of these, because there's no better asset on earth, as I keep saying, if you get it right. And there's no reason that you can create incentives through mutualization types of ownership structures along with institutional pension fund type ownership so that wealth creation is shared with the ratepayers. So, I mean, I can kind of go on and on. As you can see, we've got a lot of experience in this area. We've been investing in these kinds of businesses, for some of the largest institutions in the world for decades. Sovereign Wealth Fund in Norway, JP Morgan. I mean, those are our partners. That's our perspective really on the way to kind of proceed and to make sure that any kind of a document that gets shared is very specific and very focused, not just on regulation broadly, but on the kind of regulation that has proven itself to attract hundreds of billions of dollars of capital, not only in the developed world, but in some of the emerging markets on earth, and have done so consistently for decades, profitably for investors and beneficially for ratepayers. Maybe I'll just leave it there.
Thank you very much, Matt. That's really helpful. As I say, I think doubling down on that point about enabling environment, I think it means different things to different constituencies, and I always sort of try to impress upon colleagues on the advisory board, you know, a bit of a lone voice sometimes, but you know, the point I always try to make is it's about investable regulation. It's about the types of incentives. Money has options, capital has options, and how do we actually meet in the middle and create that optimal and appropriate alignment so that we can meet the objectives of this advisory panel, which is $30 billion a year. I keep saying to Guy, and Guy knows, you know, we cannot just sort of rewrite another development community report, which ultimately talks, you know, very ambitious in its title, but then lowers the ambition because of the inability to really understand that it's a systemic transformation that's required. And I think that message hopefully will come through, that there is a systemic transformation that will be required if we're going to successfully give the heads of state on this panel credible and realistic goals linked into their targets. Now I'm going to move on to Kate Hughes, who is the CEO of the Resilient Water Accelerator at WaterAid, a good collaborator of us, a really serious partner that we're going to be doing a lot more with, and is very committed to the African continent. So the floor is yours, Kate.
Excellent, thank you. Hi everyone, and yeah, it's great to be here. And I'm new to the Resilient Water Accelerator, but I've got a long background in kind of UK government and climate finance, so this conversation is incredibly interesting. And I probably won't say anything which will surprise you now, because I think a lot of it's been said, but we've set up the Resilient Water Accelerator to try and get underneath the skin of the challenges that everyone's been talking about today already. That investment isn't happening at the scale or the speed or in that systemic way that's needed. It's too piecemeal, it's not sustainable. Investments happen, they're not operated, they're not maintained, and actually we risk creating new pressures and challenges. And so one thing that we've particularly been designing the RWA to look at is the lack of that coordinated, integrated approach within governments while they're devising water-related policies and incentives and thinking about that enabling environment. And our challenge is here, how can we bring those different public and private stakeholders together at the outset? So not creating something just for government and then taking it to the private sector too far down the line when it's, you know, it's not going to work for them. Those conversations have to happen in the round in order to get a joined up, holistic answer. And I guess, Guy, one question for me as well in terms of the pathways that you described, which I think was very useful. They slightly came across as being separate pathways and not talking to each other, and I think it's those interlinkages, and I know that's not what you meant, but I guess it's just the point in terms of how we describe this. That interplay between all of those elements is the really important thing here. And absolutely we think that sort of financial innovation is going to be needed so that we can actually bring through those investment opportunities for water in a given watershed or ecosystem, and that's kind of the scale that we're thinking about, not individual small scale discrete projects, but looking at this level. So where can we align financial products with the environment, social, MRV, getting the right data so that we can really deliver climate resilient and socially equitable water systems? And I think this is the point from me, that if these investments aren't sustainable because they're not climate resilient, we're going to end up with stranded assets. We're going to just go backwards. You know, there's all the links to other things on the climate side, things like TCFD, and actually we're disclosing the risks in the system that's being invested in and understanding about those. If we're not designing water services which are climate resilient, then I just don't think we will get the right kind of long-term investment that's needed. But you know all of the risks and the challenges to actually investing in these elements and into water systems as well, and how can we get, again, under the skin of the right regulatory framework, the right tariffs, the right incentives and structures, which will enable these to be commercial investments as well. So we're really keen to look across those connections, that intersection across food, agriculture, industry, planning, energy, supply chains, nature, health, in order to identify the right projects, to test them in this context, and then to test them against investor appetite. So we're going to build up a portfolio and then map that across different kinds of financial structures, debt, equity, where's blended and concessional finance needed, and then we can triage them. Does it need more feasibility? Does it need more local or city regulation or national regulation? What else needs to happen in order for this to be investable in the real world and at scale? And our idea is that we can kind of build a feasibility facility as well, so that actually we speed up that process rather than every single time everyone doing it with a blank piece of paper. And we see that's where also there's a real barrier to accelerating investment, getting past that stage and working out how to do it time and time again. So we're really keen to work with lots of people on this. So a quick little just kind of request to anyone on the call who would like to find out more. As others have said, actually, there's lots of initiatives. We're really keen that we join up, that we're talking to others. We'll be doing stakeholder consultations in Lagos. So get in touch if you're interested in that, and we'll be in New York as well. So thank you.
Thanks very much, Kate. Really powerful point that I think, it's really important for us all, both public sector, private sector, civil society, and whomever else, is this ability for us to be able to operate as an ecosystem and really leverage that alignment. Because the reality is, as I'm sure we all know, Guy knows indeed, that, there's only a certain part of this solution that private capital is mandated to be able to participate in. And I think what we're really looking to do is to see how we can optimize that as a key player in the ecosystem, and then create a bit more balance for other pools of capital, and be it public or blended or philanthropic, to be able to play a different role in the chain. And then we have this virtuous, rising tide lifting all ships. So now let me move on to Eloy for his remarks. Then we'll go to Joseph, Ngatia, and Demba for their remarks. Over to you, Eloy.
Yes, thank you, Hubert. I'm talking from the perspective of somebody who lives in a country where 1/3 of the land is below sea level, and by the end of the century, 2/3 will be below sea level. And it will be no surprise to you that this had led to a long tradition of building very robust water management infrastructure in the Netherlands, starting, of course, with dikes, but also water locks and the whole water supply system. Now regulation obviously is important, and I would like to stress here that it's also important to decentralize at the same time. So you actually, if you look at the tradition of the Netherlands, the first forms of government were actually water authorities, which were actually quite decentralized in this setup. And they were very successful because there was a willingness for the people living in that area of that water authority to actually be taxed and pay for the water management infrastructure that was being put in place. So you're generating revenue streams that would allow investors, long-term investors, to tap into that market. So it's really actually, I'm always surprised when I actually look at the history of this business in the Netherlands, that we still have bonds which are issued in the 17th century, which are still paying interest, which are issued by water authorities, which still exists on a decentralized level. So now, to give you an example, a bond that was issued for 1,000 guilders in 1640, in today's money, that would be like 5 million, euros. It paid an interest of 5%. Today, that bond is valued at about at a market price of about 300 euros. It's still paying interest, about 11 euros interest per year. Some are perpetual bonds that are similar to that. But if you think about the amount of wealth was generated by the issuance in that point in time by these financial instruments, but there was apparently an environment that people were willing to buy 400-year bonds. Because there was some sense that the wealth that would be generated by building dikes and facilitating agriculture and whole industries behind those dikes was such that they could easily be paid the interest. So on the one hand, it's a willingness to tax and pay, and also an ability to structure these things with a view of bringing in the private sector together with local authorities to actually structure very good long-term investments. And to give you an example of how that is done today, pension funds work together. When I was at PGGM, we established a joint venture with one of the large engineering firms in the Netherlands, BAM. We put 1 billion euros into that joint venture, and we would bid for large contracts in the Netherlands to build new locks, to renew dikes, and the government would then provide us with an availability payment for the next 20-30 years for the maintenance of that dike or lock, and that would become a great investment for the pension fund to actually hedge its long-term liabilities. So bringing long-term capital to the table with, you know, good framework for public-private partnerships, and indeed stable regulation and evolving regulation over time is important. So I also like the point I think Matt made, that you need dynamic regulation or dynamic solutions. And so there's a different approach here in the Netherlands for mega projects that go into the billions that are really led by the central government, and projects at a more local level. For instance, if you have a water lock which has to be renewed, the cost is 150 million euros, then actually businesses in the area that profit from that new lock will actually have to contribute 1/3 of its cost. And then the rest will be raised through general taxation or other measures. So there is a good, stable regulation, dynamic solutions, and decentralization. I think important lessons from the Netherlands. I think that can be implemented in other environments. So although we can do endless studies on what is the best type of regulation, I would very much favor, for instance, in a large country like South Africa, you can start at a regional level, institute authorities which have the ability to raise local taxes or tariffs to pay for these water infrastructures, and then give them concessions that range into, you know, multiple decades, and then have a contract with the private sector that we will keep those rules in place for a long time. And if they don't shoot you over time, you adjust the mechanism for another location, but trying to maintain stability over time, so drawing that long-term capital.
Thank you very much, Eloy. I can see Guy leaning forward with great interest when he's hearing the recurring importance of the regulatory environment, when he's hearing the importance of alignment, and that great example that you've given. I think, again, we're coming from a continent where everyone else has sort of helped define us as this development space, when really, you know, some of those best practices, some of those, you know, mechanisms, tools, and market structures that have been used successfully around the world, there's no reason why they can't be applied and employed on the continent. And I think it's very, very important that, you know, reports and authors of reports reflect this realism, reflect this opportunity, and that's why we're so pleased to have you with us here, Guy. Now let me move to Joseph Watting from KC Family Programs. Floor is yours, Joseph.
Thank you, Hubert. Thank you, everyone. So I work for the foundation of the founder of UPS. And you see those planes flying to many parts of the world. So needless to say, we invest globally, and I've been investing on the continent for a number of years and decades. You've made most of the points. Thanks, Guy, for your presentation. So I'll be very brief, and I'll touch on some of them, and we can have a dialogue, you know, after this WebEx. I'd like to start off by three things. One, the enabling environment, execution risk, and the third one has to do with the asset owner. And speaking from the perspective of the asset owner, are we speaking the language that the asset owner can, in a language that resonates with the asset owner? And I'll address that in a moment. With respect to the enabling environment, both Sharon, Matt, Kate, and Eloy have talked about it. I will not belabor it. I would say that it's super important. When you talk about Africa, most institutional investors think risk. we need to be able to follow the trend lines as opposed to the headlines. And part of it is having an enabling environment that respects capital, attracts capital, and is able to deploy capital at scale. So the model law certainly is a tool that can be used. And I would like to note that I like your audience, Hubert, the heads of states. I cannot overemphasize, the importance of political will. If that will is not there, nobody will send capital over there. A politician told me in Brazil that their political assets and liabilities versus financial assets and liabilities and the discount rates are not the same. If the political will is not there, no money will move in that direction. The points about the tariffs is super important. How you're able to get repayment for the various forms of capital and still meet, your either government goals or your social responsibility goals, which we have. You don't want to price out those who need it. And Matt, I like your comment that for an asset that delivers 10% real, I would love it. But we don't hear that much from the consulting, community. You don't hear that narrative that much. What we hear is risk. And the whole thing is on how do you integrate the whole concept of water, a scarce resource, into the asset liability framework, into the asset allocation framework. How do you get paid for it? It's not just a correlation thing. And if you're looking at the base currency of a US investor, as an example, how do you deal with things like, currency risk? It's not just a correlation story. These are things that need to be addressed or brought in front of that institutional investors. As to whether we engage the consulting community or as to whether we address them directly, I think that's a missing link. And talk about the language. We need investable assets. You may talk to someone sitting in my seat, bankable, great. What does that mean? We want to be able to invest in assets that make a difference. And I also want to talk about what I call the execution risk. Besides having government policy aligning with the investment theory, which leads to better results, execution is important. A bad project does not become good just because of a guarantee or just because it has the label that is coming from the EU, African Union. No, nobody cares. We have tons of ideas competing for capital. 10% real will resonate with a number of people. So having that capacity to deploy these assets, being able to take the project to the finish line, success begets success, to me is super, important. And we should be transparent. We should be able to tell our story, the good, the bad, the ugly, and be able to put forth and back our words with the actions. My final point is that there's a lot of private capital sitting out there and we need to tap it. So the DFIs and the government should not crowd out this private capital. So structures, which Kate mentioned, I'm very much I lean towards that. If you have, first loss structures, whether the governments will put, tranche, the risk, provide first loss, or if the DFIs, the MDBs will consider that first loss to crowd in capital, which will make a change. The impact is very transformational. I'll end on this point, since there are other parties, but there's a lot to be talked about. So I'll end here. Hubert, hand back to you.
Thanks very much, Joseph. I mean, the fundamental takeaway here, I think that Guy, I can see is really understanding is, who is this report ultimately seeking to influence? And if it's not, that it's a number of different constituencies, but, we cannot urge you enough to ensure that it can be read by institutional investors, but it will have a degree of simplicity that a trustee board member of a pension fund who is part of the investment decision-making process is not bamboozled with development speak that doesn't necessarily help them feel empowered and equipped to discharge their fiduciary responsibility when taking an informed investment decision. I'm now going to move to Ngatia Kirungi from the Kenya Pension Fund Investment Consortium. The floor is yours, Ngatia.
Thanks, Hubert. My comments will be quite brief. I want to take the perspective of the domestic capital, so the pension schemes. So I run the KEPFIC, or the Kenya Pension Fund Investment Consortium, which is a consortium of now there are almost 32 pension schemes that have come together to jointly invest into infrastructure opportunities. So the first thing is regulatory allowances for the pension schemes to actually invest into these assets is critical. It doesn't matter if you know what the returns are, but if the regulators do not allow the pension schemes to invest into them, then money just won't flow. So the first thing is to you know, set the ground right before even coming to these local domestic sources of capital. The second is the use of the appropriate instruments. Given that these are novel investments, you can expect that the risk tolerance is going to be quite low. And on top of that, pension schemes are ordinarily quite conservative. And so using capital market instruments such as bonds and the likes is critical, because it allows these pension schemes much needed ability to exit should they need to. You know, it would be allowed, you know, the instrument should be tradable and would provide the liquidity that these pension schemes demand. And last is a point on returns. So when structuring these projects, you know, the fact remains that one return may look good to one set of investors and you know, might be insufficient for another. So we have to ensure that the returns are appropriate for the particular market in which this capital is being sourced from. Usually the hurdle rates are domestic bonds, you know, government bonds, and because that's where the money is currently parked, and that is what is seen as the opportunity cost. Any investment that comes in under those government bonds is unlikely to see any capital flowing into it. There is a place for guarantees, especially where these guarantees would make the pension schemes a lot more comfortable. We have seen this in the road sector here in Kenya, where we had our first large investment of about $50 million into a road all the way in northern Kenya, near the border of Ethiopia and Somalia, a place where you'd never expect a conservative pension scheme to invest in. But together with the donor partners who provided basically a AAA guarantee, that investment was oversubscribed because of the other 2 points I made. First, they used capital market instruments, and we ensured that we had the regulatory buy-in for pension schemes to invest. So I'll stop there. Thank you.
Thanks very much, Ngatia. Great to give a live example. Just to close us out, if I can now call on Demba, who I mentioned before is the CEO of the Senegalese Sovereign Wealth Fund, and whose president is actually the leading champion and sort of prominent co-chair for this initiative, along with the Prime Minister of the Netherlands, as well as a number of other African heads of state and personalities. The floor is yours, Demba.
Thank you, Hubert. Hi, everyone. So I will try to make it brief because we can spend the day talking about water, because it is one of the most important sector in terms of country stability and also in socio-economic development, side health and education. So I have a very hands-on experience of water. Actually, our Francis own 55% of the water service company. Deserving cities in Senegal. So I'm an investor in there. So I am seeing day-to-day, as a member of the board of this company, I see day-to-day issues in terms of operation, in terms of cost, prices, customer not paying, and all those operational issues. And also, we are involved into the turnaround of rural water services company. There are two of them. And for example, tomorrow we have a one-day meeting with the Minister of Water of Senegal. So, for instance, we are really involved in the water sector in Senegal. So, if I want to make it brief, the first thing to make it to have investor is the political sponsorship. It is really important. The politics have to show commitment, involvement, and a long-term vision of the water sector. The second thing is the regulatory environment. What has been done into the telecommunications sector and the energy sector should be done in the water sector. It is a growing sector, and it's not, let's say, a sector where people cannot invest. You can invest there and get some money back from the investment. So this is really important. So when you talk about regulatory, you're talking about how you segment the sector. Do you segment it by having water, drinkable water producers, transporters, and distribution? So water service company. And also, there is one thing which is really important in the regulatory environment. You have to decide who owns the asset. Here in Senegal, the government invests into the asset. And the water service company is here to take care of the distribution services. And one thing which is really important is, do you differentiate urban and rural areas, or do you put all the countries in the same? So these are linked to regulatory environment, which is really important, that has to be fixed and decided. So once you have the political sponsorship, you have the regulatory environment set the right way. The next thing that is more linked to execution, to lower tariffs. I mean, where do you put your water plant? How do you transport water? And also, one thing which is really important in terms of water production, we have to be looking at the regional and sub-regional level. For example, here in Senegal and the surrounding countries, Mauritania, Mali, Guinea, what we are doing in energy with OMVS, we have to do the same thing in water. So having some common asset of water production, so that we'll be able to produce water in a more sustainable way and in a more efficient, cost-efficient way. So this is really important. So thinking at the regional and sub-regional level is about producing the water. Thinking at the national level about how I differentiate rural and urban. Thinking about whether the government should own the asset or we should have the private companies invest into the asset. And all the other things that people talk about are very important. Who is the referee? And what position should the government have in terms of arbitrating the differences between the tariffs? And one thing which is really important, because I did some tests 7 years ago, you have to introduce technology. Technology in order to make sure that you have not so much water loss, that your water production and transportation is efficient, and also you move from post-paid services to prepaid services. And the fact of moving from prepaid to post-paid will have an impact on the working capital and will have impact on the risk. That's why introducing some technology like IoT with low power wide area network like LoRa and Sigfox is very important. So I will leave it there because I can speak for hours about this area, but just remember one thing: political sponsorship, regulatory environment, and thinking at the regional and sub-regional level for water production, and introducing some new investors like independent water producers. So this had been done on the energy side, it should be done on the water side. Thank you.
Excellent. No, really great inputs there. I saw Guy ensure that he's taken those key, very specific and clear recommendations. I'm mindful that we've gone over, but I see that there are just two colleagues. Anne-Marie, would you like to say a few words? Eric, would you like to say a few words? I see Eric's hands up. In the interest of time, Eric, the floor is yours.
Well, thank you so much, Hubert, and good morning, good afternoon, colleagues. I agree with a lot what has been said, so let me just add 3 quick additional points from the perspectives of an institutional investor. One is, I think, we really do need to build on the momentum around reimagining the multilateral development banks. And the essence of the problem, if I can sum it up very briefly, is their current mode of operation is to maximize their own investments. And that is a problem because right now, pension funds and other institutional investors, if you look at the amount of resources we have, our balance sheets are approximately 1,000 times larger than those of the multilateral development banks. So if you're going to get to scale, you need to focus on where the resources are. And institutional investors with infinite time horizons, often because we're pension funds and things like that, are the ideal source of capital to tap into. Unfortunately, the multilateral development banks, a lot of the development finance institutions, they're not doing this. So in essence, to sum it up, what they should be doing is seeking to maximize the total amount of investment that's flowing into countries, not maximizing their own investment. So that's the first piece. The second one is, it was mentioned that we need a better project pipeline. Couldn't agree more. The upscale project preparation side of financing investments, this is about 10% of typically the total project cost. Takes everyone from 3 to 8 years, and it's a complete market failure right now. The leading institution globally that does this, the Global Infrastructure Hub, they deploy something around $18 million towards this, which is absolutely incredible when you think about the scale of the problem. We were speaking to the Global Infrastructure Hub, and their own stats suggest that for every dollar they invested in upstream project preparation, they were able to mobilize $246 from the private sector. Now, that's an incredible ratio. We'll never be able to really replicate that particular ratio at scale, but it's illustrative of the power of really focusing resources on targeted areas such as upscale project preparation. Because we can mobilize as much institutional capital as we want, and there's a huge appetite for it globally, but not a cent of it will be deployed if there aren't bankable projects in which to invest in. So that's the second piece. And then the last piece is data. For many institutional investors, particularly those who are not located in the African continent, the African markets are often new markets for us, for which we have very little knowledge and information. A lot of the multilateral development banks have huge amounts of information within their institutions, and they do not share that by and large. Or if they do, they aggregate it, and average it out to such a point that it's essentially useless for those who are making investment decisions. So really, they need to be more willing to share their internal data, which what will happen, it will lower the risk perception because we'll have better data, which of course drives down the cost of capital. So those are the three main elements I just wanted to flag very quickly. CDPQ has worked a lot on these in a number of fora, the B20, the UN, and I'm happy to share that to you, Guy, through Hubert, some of the recommendations that we've put forward in those venues as you formulate this current report. Thank you.
Thanks very much, Eric. Great points. Let's democratize the data. Particularly investment decision useful data. And of course, let's not pretend that a $1.5 trillion balance sheet can solve a problem that, better than a $200 trillion balance sheet under the right circumstances with the appropriate mandate alignment between public finance and private capital. Last call to Anne-Marie. Are you back with us, Anne-Marie? Should I cede the floor to you? Okay, I'm mindful that we're grossly over time, so thanks everybody for those comments. I don't know, Guy, if you want to have any sort of closing out remarks, given what you've heard and shared.
Wow, that was really great. That was a masterclass for me. Luckily, a lot of what you said agrees with what I was, I had formulated to some extent in the report. It needs much stronger emphasis, stronger wording, and maybe structuring it in a way that puts these messages more upfront. So I hope, you're very welcome to give comments on this current version. It will go through one more iteration, which will be shared before we go into the finalization process. So, you don't need to remake any points you've already made, but if you see anything that can be improved in the current version, then please let me know. Thank you so much for your time, and thank you, Hubert, for organizing this meeting. it would be great to sort of have your emails so that I can just contact you about any particular follow-up I have from the discussion we had. Thank you.
Fantastic. No, we'll absolutely make those details available, Guy, and thank you for being open to understand that, you know, this group here are very committed. Matt told you he's been looking and lobbying many different parts of the world to recognize African water as an investable asset class and to position it as that. You know, I don't think I can stress enough the importance of, as best as you possibly can, ensuring that the report speaks our language, or at least when we get the report from you, you know, we can use it as a tool to really enlist more support from you know, investing institutions. You know, we know that so much money has been expended on development reports designed to mobilize capital, but really it's development community talking to the development community. And that's why I sort of take my role on the advisory board very seriously. I was given a mandate to really sensitize the institutional investment community, both domestically across the continent, as well as globally, you know, with our peers, pension funds, sovereign wealth funds, endowments, foundations. So whatever you can do to ensure that it's a wholesome, relevant, and useful read for our constituency, would be, you know, entirely grateful. So with that said, please let me first of all thank you for your incredible, you know, insights. You know, really, really valuable. At the start, we mentioned there's going to be a UN Water Conference in March. It's going to be, you know, star-studded event. It's going to be one of the biggest UN summits focused on anything. It just so happens it's going to be on water. This coincides with the fact that, you know, we are currently under a COP27 African presidency, going into a very seminal and strategic COP28 in the UAE as a global stocktake. And adaptation and water are going to feature very highly, and the views of and the mobilization of institutional capital is going to be high up on the agenda. So we will be staying in touch with each of you individually and you know, as a group, because we may be doing something similar through the Global Water Partnership linked into the event at the UN in New York as some form of side event, similarly with Water Aid and a number of others. So I think the more we can come together in support of some of these key messages, that's appreciated. So thank you so much for your time and your participation, and I look forward to staying in touch.
Doing business in Africa, you can't afford to be without Africa Investor.